If you look at almost any mainstream finance video in Australia right now, you'll hear a variation of the exact same terrifying statistic, that on a standard $500,000 mortgage, you could pay over $500,000 in pure interest alone over 30 years. You're potentially paying back more in interest than the actual value of the loan itself. This is one of those statistics that is both incredibly powerful and also sounds like it surely cannot be true. Like the fact that Gwyneth Paltrow is not just the CEO of a company that sells vulva-scented candles, but also somehow an Oscar winner. Now, while I may have very strong feelings about the fact that the lady from Goop and Shallow Hal beat both Cate Blanchett's Elizabeth and a peak Meryl Streep to a 1999 Academy Award, a cinematic injustice that I routinely lose sleep over, it's actually the mortgage fact that I'm going to focus on in this video. Because yes, over the life of a loan, interest can become absolutely enormous, which is why almost every finance video eventually lands on the same conclusion: pay off your home loan faster. But what if there was a way to reduce the interest you pay, potentially pay down your loan faster and still keep access to your money? Because paying extra off your mortgage isn't the only way to change how much interest the bank charges you. Hello and welcome to Acting on Finance. I'm your host David, a man who finds themed male and female logos on restaurant toilets less of an enjoyable design choice and more of a deeply confusing intelligence test that I regularly fail. Now, before we get into it, quick note, this is for education, not financial advice. Although if I was giving advice, it would mainly be to stand near the basin and wait a minute before trying a door, because statistically, someone will either enter or exit and reveal which toilet you're actually supposed to use. So before we get into this, we need to quickly understand how your home loan works. With a standard principal and interest loan, your repayments are made up of two corresponding components: principal and interest. With me so far? The principal is the portion reducing what you owe, while the interest is effectively the recurring fee you pay the bank for the privilege of not being homeless. The important thing to understand is that lenders calculate interest based on your loan balance. So when people tell you to pay your mortgage down faster, the logic makes sense. Reduce the debt, reduce the interest. While they may be lying to you about how clean their house is or that they totally didn't get veneers, finance creators aren't lying to you about the math on this. Paying down debt reduces interest. This is true. The problem is when people present it as though physically handing every spare dollar back to the bank is the only way to achieve that outcome. Because here is the Shakespeare in Love winning Best Picture level shock twist. You don't necessarily need to pay off your mortgage to stop your mortgage from costing you interest. And this is where we need to talk about one of the most powerful but painfully boring sounding financial tools ever created, the offset account, which is essentially a savings account attached to your mortgage where, instead of earning interest like a normal bank account, the money sitting inside your offset reduces the amount of your loan the bank charges interest on. Which sounds about as exciting as reading the terms and conditions on a software update. But hidden inside that boring explanation is something pretty incredible. Because imagine you have a $500,000 mortgage and you manage to save $100,000. Most people assume your main option is to take the money and throw it straight at your mortgage, reducing your loan down to $400,000. And that works. But with an offset account, you could keep your mortgage sitting at $500,000, place that $100,000 into your offset, and the bank will still calculate your interest as though your mortgage was $400,000. The same reduction in interest, but with one very important difference. The $100,000 is still sitting there, which is fantastic if you're disciplined and less fantastic if you have the financial self-control of Joe Pesci and Daniel Stern wandering around New York in the 1990s looking for a 12-year-old to beat up. Because yes, technically the money is available, but if your emergency fund mysteriously turns into a jet ski, a European holiday, and a life-size Baby Yoda statue, then unfortunately the offset account wasn't the problem. You were. But assuming you don't treat your offset account like the sticky bandits treat an empty mansion at Christmas, this creates three important benefits that often get ignored. Firstly, you reduce interest. Because the bank is no longer calculating interest on the portion sitting in your offset, meaning the bank still get their repayments, they just don't get the pleasure of charging you the interest on top of that amount. And honestly, isn't preventing the bank from taking more of your money what life is really about? Secondly, it can help reduce your loan faster, because every payment is essentially a fight between a principal and interest component. The less money disappearing into the interest component, the more of the repayment that can go towards reducing the principal component. And third, you maintain access to your money, because while spreadsheets are fantastic, life has an annoying habit of not asking Excel for permission before things happen. Cars break, kids need things, hot water systems decide after 15 years of loyalty that 2 a.m. on a Tuesday is the perfect time to help you really feel the never let go Jack scene from Titanic. Having access to cash gives you options, whether that's an emergency, an opportunity, a holiday with your family, investing in shares, or the same 3 ETFs the internet discusses with the same level of intensity usually reserved for ancient prophecies and the second coming of Jesus.
Using the example from earlier, a $500,000 mortgage over 30 years at 6% interest rate, holding just $25,000 in your offset account has the potential to save you over $100,000 in interest and pay your home loan off around 3 years earlier. Scale that up and the numbers get pretty crazy. A $100,000 offset balance could save you over $300,000 in interest and almost 9 years off your loan. And at $200,000, you're potentially looking at saving over $500,000 in interest and cutting more than 15 years off your mortgage. And that's the real power of an offset. You can reduce the interest you pay your home loan down faster, and get those real benefits without actually handing the money over to your bank.
But the point is, having access to your money gives you choices, and that's the part that gets missed when every conversation becomes, there is only one correct answer. Because unfortunately, personal finance has the deeply annoying habit of being personal, meaning the perfect strategy for one person might make absolutely no sense for someone else. Which is frustrating because I would also prefer life came with one universally correct answer, right alongside a definitive explanation of why my toddler specifically requested a banana, watched me peel said banana, immediately became emotionally devastated by the existence of the peeled banana before maintaining direct eye contact and slowly dropping it on the floor in a way that can only be described as deliberate, methodical, and quite frankly, intimidating. But apparently, some mysteries of the universe remain unsolved. So yes, paying off your mortgage early works, but sometimes the biggest financial advantage isn't finding a secret hack, beating the algorithm, or listening to the loudest person online. Sometimes it's simply understanding how the system actually works. Because if you don't, you can find yourself on the losing side of something that really should have gone your way. Much like Hans Zimmer creating one of the greatest animated scores of the 90s with The Prince of Egypt, only to lose Best Original Musical or Comedy score to Shakespeare in Love. I mean, this is the same guy who went on to give us The Dark Knight, Inception, Interstellar, and had already given us The Lion King. Come on. So let me know in the comments, do you use an offset account? Did you know this is how they actually worked? Or have you been aggressively transferring money into random accounts and hoping the bank somehow appreciates the effort? And if you enjoy someone explaining finance while becoming unnecessarily angry about movies released more than 2 decades ago, consider subscribing, because apparently this is just who I am now. And while you're there, feel free to tell me about your biggest financial misconception you'd like me to look into. Or if you just want to complain about the 1999 Academy Awards, honestly, that feels like an equally productive thing to do at this point.